Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, June 9th, 2021. More of a follow-up to today's earlier video. So we do have what I believe to be decent, not the best looking sell signals I've ever seen, but decent sell signals on both the industrials and the financials. So I'll take them on face value for what they are and call it as such. Sell signals there, and that's what I've been waiting on. As I showed you in today's video earlier, there's certainly a little work to be done. In other words, quite a few of the market-leading financial stocks have broken trend, and quite a few others are sitting at or just above comparable support levels that have not been broken. So let's just go over the charts. We'll keep this one brief, and again, show you some of the things I'm watching. So of course, the financials and industrials are one sector. I could be right on the call there that they're going to correct it from this point, but still wrong on the call that it's going to take the market down with it. Why? Because we can see rotation into other sectors, namely technology, which is certainly corrected well in advance of the other sectors. There's our XLK, the tech sector ETF. We can look at it this way or this way. We put in a divergent high back here. Remember, this one makes up a quarter of the S&P 500, by far the largest. And we corrected back to this right here, this alternative trend line or minor trend line there. And lately, you can see we've been moving up. So maybe the financials are the tech picks back up the baton. Lately, the industrials and financials have held the baton. So I'm just pointing out what to watch for. You really want a good sell signal in the market. If you want that, you want to see this trend line on XLK get taken out. And even better, this is a really big level down here on XLK, the tech sector ETF. It's about, let's just round it off at about 125, 126 right there. It's more of a support zone. Why is that a level? Let me turn off all the lines and draw it out, because that's these highs we had back here. Where'd it go? 126, 125, right here. We had this reaction high, and there was a breakout there. We back tested from above, we held it, came back in, back tested again, came back in, back tested it there. Those are intraday candles, but we closed right about on or a hair below it. Another successful test, and we've started to move up. So that was a breakout, all-time highs. And should we come all the way back down there, what's interesting too, I think you can just make it out here, and if you can, I'm going to turn the levels up. You have the 200-day exponential moving average as well as the 200-day simple moving average, which come in right about that level as well that I was just on. So we're quite a ways from there. Now here's the thing. We could certainly come back in and have another test of it. We've tested it multiple times. And just to back test it and to test the 200-day moving averages, which it would be a target, by the way, for the next correction, that's about a 9% drop. So it's going to take us about 9% to get there. These 200s are key moving averages, and every time you get too far away or you are far from them in distance or in time, you usually come back and check them from time to time during a bull run, bull trend. So, and then when you're below a bull trend, that's bearish. This was a major breakdown, but the Fed came in and foiled all things technical with their nuclear option back here, and so we snapped right back above it. Back there, you broke down and you were below the 200s, and there was a trade to be made. In fact, there was a trade to be made there. And again, those are key levels. So when the 200 breaks, again, it's not like call it a whipsaw if you want, but there was another 21 or 20% plus drop. And back here, when we broke in the fourth quarter of 2018, there was about a 19% drop. So those are big levels, and you can see these 200-day moving averages just do a bang-up job, especially with tech sectors, the NASDAQ 100, certain key stocks. It delineates bull and bear trends, bull trend when you're above, and it also acts as support on pullbacks. You want to buy pullbacks to the 200. So again, from time to time we come and revisit it, and I even have a custom indicator that I put on this chart here. I'm going to just jump over to that real quick and focus on it, and it shows you the percentage that you're trading above the 200-day moving average. And this was an extreme back here. You roll back in time, and we haven't seen that in a long time. And usually when you get too far away from the 200-day, you come back in and you check it. You got quite a bit above it there. You eventually come back in. Came back in here, tested it, and there's an example of how you often bounce off it. Okay, but the main thing I wanted to talk about today was is those other sectors. So here's the S&P 500. This is my clean board of it right there. clean version. There's our low from 2020 back in March, and that was broken here and back tested recently. We've been moving above it, and then just below it I have this minor or secondary, what I call BOD, or benefit of the doubt trend line. That comes off. It's that purple line right here from back in late October, and that needs to get taken out. And then the first pretty significant support's about 404 right there on SPY. There's your 200-day moving averages, and again, same story. The percentage above the 200-day moving average right here. And it's been a while. It's been a while since we've checked the 200-day, but you can see back here, this shows you when you pull back to the center line there, that means you're on the 200-day, and you can see. And again, if I could scroll back longer on this particular charting program, I can only go back a few years on a daily time frame, but you would see that quite often in a bull trend, you pull back to that level, but once you break it, that's support, and then you tend to drop well below it. So far we're holding above the 200. And again, next correction, if you're just looking for a pullback target to load up on longs or cover shorts, again, it's just one of many levels. So what I'm trying to say is I wouldn't solely target that. If we start to correct, if we get more downside in the financials and the industrials, and they take the rest of the market down with it, like I think they will, again, that's a rough guide to where the buyers are likely to step in. A lot of buy programs will fire off automatically on those 200 days, pullbacks to the 200s. But what I would be doing, and what we will be doing, is looking at the charts at that time. Intraday charts, the 60-minute charts, the daily charts. We'll be looking at QQQ, SPY, the financials, the industrials, market-leading stocks. And what I like to see is the, it's like kind of, I always use the analogy. It's like a, legal case. And, you want the more evidence you have as a prosecutor, more likely you are to get a conviction. And when you're trading in the markets, the more evidence you have to go long or short a stock, the stronger your case is. It means more likely it's going to work out. Like I said, I wouldn't go solely long or close shorts. If I am short at the time or looking to get long, I wouldn't reverse to a long solely on the fact we hit the 200. But usually, again, I've done this a long time, and rarely have I seen a slice right through the 200 like it's not there. You slice through it briefly, and then back here, and then you consolidated on it for about a week before it was given up. Okay, so that's enough on that. Let me park this again out of the way. And there's our secondary trend line. And then I also said in some recent videos over the last couple of months, one thing I wanted to see is the Wilshire 5000. That's probably the single best measure of the entire stock market. The S&P 500 is a good measure, but remember, they're all mega cap, very large cap stocks. You're missing the whole arena. There's many, many more small and mid cap stocks out there. So this one kind of has them all. And I said for the market to break, we need to see the equal weighted S&P 500 as well as a Wilshire give way. And we did. We broke down, as I highlighted back here. We had a breakdown and a back test. And sometimes you break down on a chart, you break a support level, like a trend line, and you never look back. Sometimes you back test it, and sometimes you push on up to make a marginal new high. And most importantly, all along, these divergences have continued to build. The same divergences that were in place at the breakdown have not only not been negated, meaning not been taken out with higher highs on the indicator, but they've grown larger. And that still warns of a likely correction coming. But you just need the sell signals, such as breakdowns in various sectors and stocks. Then I gave you this alternative trend line, which we did break down recently. I'm going to zoom in nice and tight. We've been back testing, just hugging along there, and sometimes that happens. And that's why I always say, shorting a back test is tough, because if you short, if you miss a breakdown and then you wait to short for the back test, well, you can continue and often do back tests for a long time. So what you want to see is after back testing, you want to see an impulsive rejection off there. And that will say, okay, we back tested, and then that impulsive rejection means buyers finally gave up and weren't able to take the security back above the trend line, and the sellers, at least at that point, won. So that's what we're looking at there on the Wilshire, and I showed you the S&P 500. Now we're going to look at, here's the equal weighted, S&P 500. Same thing, it's below trend. That's the SPEWX, or they have an ETF that tracks it to RSP, and you can see that one. And that's a clean uptrend line too. Look how many reactions starting back here, the March 2020 lows. Clean reactions there, reactions there, reactions there, reactions there, and then just recently, boom, we broke down, made a perfect back test. It kind of moved around sideways. So like I said, we're not, it does speak to the resiliency of the market, that was a pretty decent sell signal, but yet we moved sideways. And again, when we look under the hood, which we've been doing lately, said, look, yeah, we have sell signals on certain indexes, certain sectors, certain even some market leading stocks, but we don't have sell signals on all the important sectors, including the financials and industrials, until today. Now let's get to that and we'll wrap the video up. So there they are. There's XLF. You see different lines here, but the most important line is that primary uptrend line off the lows, well defined. Again, covered in today's video, so I won't spend a lot of time. We had a breakdown yesterday, yesterday, and then follow through today. That's what I want to see. So to me, that's a check mark. Is it the most convincing, the most impulsive breakdown I've ever seen? No. But sometimes I like these quiet little stealth breakdowns. When sometimes I'll see things that the rest of the market isn't seeing, and then once it becomes clear to most, oh wait, financials have broken down. The more eyes that see it, then you start to see profit taking in the financial sector. You start to see the shorts get encouraged to finally start taking a position, and that should bring us down there, and it usually happens pretty quick. So like I said earlier today, I think it's objective to be short, have an initial short position. Can't load the boat yet for reasons I mentioned earlier, and we don't have solid sell signals across the board on all the indexes and market leading stocks. It's still possible we're just going to grind sideways for a while. Remember, the summer months are usually what they call the doldrums in the stock market. Trading activity tapers off, people are on vacation, and you could just grind around here for a while. But right now, again, I'm going to consider this a confirmation to yesterday's breakdown and give it a check mark, and I think that increases the odds we're going to go down and hit at the very least my first target, and I shared the additional targets in the video earlier today. XLI, the industrials, that's a pretty nice candle. It's not the biggest, most red candle I've ever seen, size-wise, but remember, it's more about where they come. I talk about that quite a bit. There's a huge red candle right there. I'm trying to box that in. Let me zoom in a little bit. Right here. And there's a pretty big red candle, but they were noise. I talk about that a lot. One big up or down day in any stock or index or ETF, to me at least, is insignificant and meaningless unless there's unless you can take something else from that, a buy or sell signal. In other words, this big red candle and this one, they didn't break a trend line, they didn't do anything. In fact, all they did, this one fell to support. If anything, it was a buy right there because we had a drop down to support. We held that support the next day. I'm talking about this 101.37. We tested it again there. So what happens now is we broke down yesterday, but it wasn't very convincing, and now we have a red candle, and so again, I'm going to give it a check mark. It's not the best I've seen, and I'll go through the industrials soon and give you some individual trade ideas. Just like the financials, I have a mixed bag. I have quite a few industrials breaking down and below trend, whether it was just in the last couple days or even sometimes a few weeks ago, and yet others holding up. So one thing's for sure, at least at this point in time, we're not in any type of, you can't even say we're in correction mode. We're right off the highs. So, what I'm trying to do here, and I made this, the call today that it's a ballsy call, and I'm likely to eat crow, but I think it's a top call for the S&P 500, and it doesn't have to be the top, just a call for a correction. Like I said, and I'm talking 10% or better when we're talking about a correction. So we'll see. And look, in a day or two, if we do this, whoosh, and snap back above those levels. Well, number one, just a recovery of the trend line will be bullish by itself. And of course, if we continue on much higher and we take out these divergences, that would also change the outlook. So there it is. We'll keep it simple. There's your targets for XLI, 101.37-ish, 97.80 83, 93.80, and then 90.25. And again, you can see these 200-day moving averages come in here. So what'll happen if we start to correct, they'll start to flatten out and turn down. So they're going to come in somewhere in here. They'll probably come in around that 90.25 level by the time we get there. It would play out, you know, if it plays out as I suspect, it would be something like this. Come down, you get a reaction on the 101.37, zigzag your way down, and by the time you get there, these lines should be there as well. You may overshoot them for a bit. So kind of this is a preferred swing target zone. This is for someone that says, you know what, I'm going to take this sell signal, I'm going to put a stop, appropriate stops not too far above, because that'll foil the whole, you know, bearish case, and I'm going to hold out for that. I'm not going to try to game the zigs and zags. Those are, you know, a lot harder. I've never met anyone else that kind of does what I do, trying to call not just where a stock's going from point A to point B, but all the little squiggles along the way in there. That's you know, my trading style. It's what I try to do. And if you can get it right, you enhance your returns. You know, if I'm calling for a drop in the financials, let's say, or industrials, I'm sorry, XLI, of about 13%, well, you know, if you can decide when you're going to get those counter trend rallies, cover your shorts and actually reverse long for a bounce and then get back in short again, you can turn a 13% drop into a 20, 30, 40% gain by, you know, micromanaging the trade that way. So we'll see. Let's not get ahead of ourselves. We've had plenty of sell signals, you know, on 60-minute charts or daily breakdowns on one index or one sector or the other going on for months now, and what we've seen is a lot of sector rotation. So again, just to be clear, this is not an all-in short moment, but it is, you know, this based on everything else I've talked about, sentiment extremes, put to call ratios, bull bear survey, sentiment surveys, bull bear ratios, things like that. You know, the ingredients are there, and fundamentally, like I've talked about, we're seeing the Fed do exactly how I figured this whole shift would play out, where they wouldn't go from outright being the most dovish Fed in the history of the world to the most hawkish Fed, coming in, cutting rates. I'm sorry, raising rates, completely stopping their bond buying program. No, it's a gradual talk down their uber dovish stance, which has already clearly begun. They've, you know, both in their words and their actions, they're talking about reducing their bond buying program. They already announced they're going to start exiting the corporate bond positions that they stepped in and purchased to save the, you know, corporate bond market from collapsing back when COVID hit right here. So that is all of it is a gradual, and they're doing it gradually, but they're moving away from an uber dovish stance to a less dovish stance. I'm not going to call it hawkish at this point, but it's a little more hawkish. You know, again, it's just semantics, really, how you're trying to define that. But all right, so XLI, XLF, and let's see if there's anything else for me to cover. Just not related, and there's a million and one trade ideas I've been highlighting lately for the last few months, but one I wanted to talk on is GameStop, because this is interesting. I'm giving you some updates there recently, and this one on a 15-minute chart, where are my levels? I'm sorry, I keep getting that one mixed up with AMC. AMC is the one I'm talking about. In the recent video, I showed you a triangle pattern here on the 15-minute chart, and said, you know, that break of that upside bullish, especially a break over those two previous highs, while a downside break, and, you know, this is the way I expect it to go, would be bearish. And we've walked down, but the big level to me, I might have had it the other day. Let me see. I had two boards that might have said 40. Yeah, there it says 47.33 on this board. This one it says 48. We'll call it 47 to be safe. Here it's 48, and only because we've had some more reaction, so I kind of tweak this line. But that's my level. I think that'll be we're right on there. We close the day. If you see this chart in white, these are your after hour trades, so don't read too much into that. These colored candles were the regular session, but as I mentioned in the recent videos, look at this volume price histogram. Well, you can't see it. Let me turn it up. My sometimes forget, and the videos aren't as clear on some monitors, my charts, but there it is. So what this tells me again is that in just in the last week or so here, the majority, there's been a tremendous amount of buyers. This shows you the buying, the volume in the stock at a certain price, and then below that it really drops off. There's a void, or what I call a thin zone, and even a gap right there. And it says, so if we start moving down through there, a tremendous amount of buyers. Everybody that bought, let me just turn that back down. So that's why I like to have the colors turned down. So everybody that bought, and you can even look at the daily chart, which we're not looking at here, and see the massive amount of volume. All these people will be underwater. Everybody that bought in right here. And that's how technical analysis works. It's not magic. It's just now you have these people, many of them saying, "Ruh-roh, I know the rest of the crowd." They call themselves the apes. The apes say, "Well, we're gonna hold tight, and we're gonna run this thing. The big short squeeze hasn't come yet." But not everyone has that gung-ho mentality. And even those that do, it's the psychology of trading. Your mindset's going to change when you start seeing, especially the people that are heavy in this. You're down 14% today. And if we hit just fill that thin zone there, that's going to take us down to about 33. That would be a target right here if you're, wanting to short AMC, which, according to my broker, still has shares. Again, I've been green lighted at Interactive Brokers for last week. So what I'm hearing from these guys is, this is the most heavily shorted stock. It's going to explode. There's so much short interest. I've been doing this for years, and and I stay away when Interactive Brokers has a stock. Well, they won't let you short if it's red barred, and I'm talking about the column you can add to your trader workstation that shows how many shares are available. Dark green means you can't short it right now. They don't have any for you, but they expect that they will. It's just a little thin right now, and then it goes to light green, which it is now, and I'm hovering on another monitor. It says they have at least 3.86 million shares available right now. So my point is, it's not as heavily shorted as I think that these folks think it is. But again, so where are we at here? So if we break that 48-ish level, this is my next target. It's going to be about a 33% drop. And then when you step back and look at the 60-minute chart or even the daily chart here, the momentum has stalled out. And we were consolidating, and again, you could say either way, but yeah, that little triangle type pattern, and you can see today that triangle, same one I was showing you on the 15 and 60-minute chart, clearly broke to the downside with today's candle. And when you go parabolic, once that parabolic run stops, usually you don't consolidate and keep going. Usually that's it. When the parabolic run ends, you usually have a pretty strong drop. And it's not unusual, like you did last time here, to chop around for a few days. They tried to rally it back to the highs, just like they did here right there, and fell short. And once they realized, and it's simple stuff, the way I see trading and technical analysis, when you run out of buyers, when you have at some point no more willing buyers at that point in time to step in and buy the stock, then all those that are holding it long are potential sellers, and then you have short sellers and everything that come into and hit it, and that's what happened back then. So we'll see, and I still think that'll happen now. And if that's the case, then they're not going to get their short squeeze, at least not anytime soon. And believe me, that I just gave you an intermediate target, but there's a lot more downside potential than 32. A lot of analysts have this stock valued at 0. So yeah, a lot of downside potential there for those that have the gumption or the capital to play with it and put a short trade on and just hold tight and have your stop in place and let it run. Okay, I'm going to wrap it up here. Again, point of the video was primarily to cover the industrials and the financials, and I think I did that. And just want to do an update on AMC since I know it's in the headlines, and some of you might be long or short the stock. All right, we'll wrap it up here and pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.